Hey everybody, Smart Silver Stacker here. Hope you're doing well. So it has been an interesting week for the precious metals, a very important week. We just saw the price of gold cross the $3,000 threshold for the first time in history yesterday. And at the same time, we're seeing some interesting price movement in silver as well. Price of silver yesterday rose over $34. And that's the first time we've seen that happen in 2025. Now, both metals did pull back a little bit from those highs, which, from a stacking perspective, I guess is kind of nice because we have the opportunity to buy gold a little cheaper than it was at the highs on Friday, but still near record all-time highs. And we'll talk about this slight pullback that we've seen, but I just want to kind of put this in perspective for you. Think about this. Yesterday, gold and silver finished in the red, and the closing price for gold was $29.84. The closing price for silver, $33.84. So that's on a day when they're in the red. But we'll get into some of the factors that are contributing to these moves in the metal. I'll kind of break it down and give my take on what this means, and also where the metals could potentially be headed from here. We got a lot to talk about in today's video. There's a lot going on, so let's get to it. Buy your gold and silver at SD Bullion. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. Hey, quick reminder, you can sign up for my free e-newsletter with the link down in the description. If you like these videos, you probably like that newsletter as well, so check it out. All right, so let's talk briefly about the broader markets because we saw a rebound in stocks, and that's significant because they had really been getting a ton of pain, a lot of red over the past several weeks. And this seems, at least in part, due to the fact that there was an agreement reached between Republicans and Democrats to pass a spending bill which avoids a government shutdown. And so we did see a bit of green in the markets, and a bit of green that was, I think, really needed as we headed into this weekend. There's been so much pain in the stock market. Think about this. On February 19th, the S&P 500 peaked in market capitalization at over $52 trillion. And then on Thursday of this week, where everything was in the red, everything was selling off, the market cap bottomed out at $46.78 trillion. So that is more than $5 trillion in market capitalization lost on the S&P 500 in a period of about 3 weeks. Now, is the market sell-off over? Well, if you look at the killer PE ratio, despite the fact that there's been this big sell-off over the past several weeks, stocks are still at sky-high valuations. I mean, in fact, they are higher than they were prior to the bubble popping in 1929, leading to the Great Depression. In fact, the only time they've really been higher than they are currently is in the tech bubble of the late 90s and 2000. So stocks, even though they've lost a lot of value, they still have very rich valuations. One thing you might want to consider here, and it's not financial advice, but you might consider taking advantage of this rebound that we have seen in stocks to pick up some protective puts, out of the money put options on things like the SPY or the QQQ. Again, it's not financial advice, but I did pick some of those up just in case the market bloodbath is not over. The valuations of these stocks, I think, still remain very high. There's a lot of risk there. And one of the ways that you can either protect yourself or even capitalize on this to some extent is by buying some of those out of the money puts, and they are a bit cheaper following the rebound. But enough about that. Let's talk about gold and silver and what is driving these metals higher. Now, part of that also, I think, may be the agreement reached that avoids a government shutdown and the agreement related to the spending bill, because at the end of the day here, the thing that is, I believe, really driving the metals and all of these asset valuations is the promise of continued significant deficit spending and ultimately the monetization of all of that debt by the Federal Reserve. So we just got the February Treasury statement. And this is interesting because this is the first monthly Treasury statement that encompasses a full month of the Trump administration. Now, we did see a big deficit in the January statement as well. But in that case, a lot of people say, well, Biden was still president in January. And that's true. I mean, that's a fact. So this is the first month that we've seen with just Trump in office. And what did we see? Well, we saw the deficit soared to over $300 billion. So there's a lot of talk about reducing wasteful spending. You've got Doge and Elon Musk cutting government jobs and trying to supposedly shrink the size of government spending. And yet, when you just look at the actual Treasury statement, what do you see? A $300+ billion deficit. And, the irony here is that it's like we're going to get more spending pretty much no matter what happens, because, Trump's been talking about cutting unnecessary spending, cutting waste, fraud, and abuse, and that's fine, but it's not really the waste, fraud, and abuse that are contributing to the massive deficits. It's like the cornerstone spending, right? The Medicare, the defense, the interest on the national debt, the Social Security, all of these politically untouchable things are the reason that we're spending all of this money. Sure, is there waste, fraud, and abuse? Yeah, of course, it's government. It's always going to be the case. But the bottom line is that we are just committed to a lot of this spending. And, you see this in the price of the metals and how they react to some of the data that comes out. For example, one of the things that really contributed to the rise that we saw in the price of gold and silver over the past week was inflation data, which came out, right? The CPI data came out, and it was actually a lot lower than what was expected. It was this low, flat inflation data. We also got the PPI data. It's a measure of wholesale inflation. That came out lower than expected. And when we got that lower inflation data, what happened? Well, the price of the metals was in the green in a big way. And the reason for that is because, again, it's this kind of bizarre situation where you get low inflation data, which you would think would be bad for the metals, right? Like when inflation goes up, don't the price of gold and silver go up too? But it's not the case. And the reason is because investors and markets interpret this low inflation data as evidence that the Federal Reserve will have more wiggle room to print more money and to lower rates. And we know that just about all the politicians, whether you're Elizabeth Warren or you're Donald Trump, they want lower interest rates because this whole system is hopelessly addicted to more borrowing and increasing expansion of the enormous national debt. Now, I feel like the politicians kind of talk out of both sides of their mouth. It's like, if you wanted to massively cut government spending, why do you think that we need such low rates? When in reality, the reason that we need the low rates is to finance all of the borrowing and the deficit spending. And I'm not trying to really approach this from a partisan standpoint. It just seems kind of baked into the cake with this system that we have, where you have to continue borrowing to keep the wheels from falling off the economy. In fact, that's really the thing that it has kept everything together thus far. Now, one thing I did think was interesting was we got this University of Michigan expectation data from consumers about where the economy is heading, right? So consumer sentiment has kind of plummeted according to the most recent rating, and inflation expectations are up. However, when you break this down along partisan lines, seems like there's some significant differences there. You've got, on one hand, Republicans being a lot more optimistic about inflation and the economy, and then you got independents and Democrats. Looks like they're a lot more pessimistic. But at the end of the day, if you ask me, and I know you didn't, and I know that this culture war stuff just kind of pisses everybody off, but I'll give you my 2 cents on it anyway, why not? It's that most of the systemic problems that we're facing, meaning, $36.5 trillion debt and a global economy that is hopelessly addicted to the expansion of that debt, because this debt problem is not just relegated to the United States. It's across the board. China's in massive debt. Everybody's in massive debt. Everybody's fiat currencies are being devalued. And it's sort of a feature, not a bug of the system, that's just kind of how it goes. Everything constantly has to be devalued to keep things moving. But most of these problems can't really be fixed at the ballot box. However, it is interesting that inflation expectations are soaring. And I think that aspect of this University of Michigan polling is getting things right. And that is that inflation, no matter what happens, will be headed higher. If we get reduced inflation, all that means is that it gives the Fed a green light to inflate the currency more. And you can just see that based on how markets react to inflation data when it comes out, right? That's not just my take. That's like the take of markets across the board. So anyway, let's get back into the metals and let's talk about where they're headed next, because we did see gold cross the $3,000 level, which is pretty interesting. It is a record all-time high for gold, and it kind of nibbled at it on Friday. Of course, it closed the day below that level, but still, this is a first important step towards new record all-time highs in gold. And I'm talking about in real terms, not just nominal terms, because 3,000 plus is a record all-time high nominally in gold, but gold back in January of 1980, and I like to talk about gold here because, the Hunt brothers weren't involved in that at all. January 21st, 1980, and you can find this data over at SD Bullion. They have daily price records going way back to the 70s even for the precious metals on their site. January 21st, 1980, gold closed at 850. Now, if you adjust that for inflation using just the CPI data, the official CPI data, that would give you an inflation-adjusted all-time high of gold of 34.86 per ounce. Now, in reality, it's probably a lot higher than that because the CPI data understates how bad the inflation has actually been since 1980. But even using just the CPI, we still have almost $500 to go before we take out a real record all-time high in real terms for the gold price. But we may be heading there very shortly. Let me tell you why. I think this $3,000 level is psychologically a very critical level for gold because it's the first time it's ever happened. I mean, it's not often that you cross a new $1,000 level in gold. I mean, the next one would be 4,000. That seems like it's way, way off, although it may not be. I mean, if you think about it in percentage terms, gold is up, what is it up? 38% year over year. So what do we need? Another about 33% increase to get to 4,000 gold. So, I mean, that's possible, right? If gold continues at the pace that it is at, we might be at $4,000 gold and real all-time highs in the near future. And the same story for silver. I mean, we're nowhere near even the nominal all-time high in silver of $50. And to get to inflation-adjusted highs, we'd need to be over 200. But again, the psychology here, I think, is about to shift. Inflation expectations, as we've seen in this University of Michigan report, are already on the rise. And whereas stocks, which are at these, eye-watering valuations, even after their recent decline, and investors, retail investors, mom and pops, everybody's into these things, right? Everybody has 401ks, everybody has stock portfolios, and I don't know how many people are really left to get into the stock market, but how many people are actually holding physical gold and silver bullion? Not very many, especially when compared to something like, the S&P 500 or the NASDAQ, which very many investors have a piece of in their portfolio. But as we cross this critical $3,000 psychological level, I do think that we are on the cusp of retail investors really kind of getting a clue about the precious metals and getting into this stuff. And for silver, that's going to be even more important than it is for gold. For one thing, $3,000 gold, people are starting to get priced out of the gold market, right? I mean, you go to the store and you want to buy a 1 ounce gold coin and you're going to be paying $3,000 plus. And that is simply too rich for many retail investors. It's just how it is. And yeah, sure, you can buy like little fractional gold pieces. You can always buy some gold backs. Of course, those you can buy in increments of 1/2,000th of an ounce of gold. So gold is still within the reach of just about everybody. But when it comes to kind of the more traditional stuff, even like a 10-gram bar, that's going to be pretty expensive for a lot of retail investors. And that's why I think silver is going to become very appealing. And the thing is that what has been driving the gold market, and I've talked about this a lot, but it's worth refocusing on now that gold has hit this sort of critical psychological level. The thing that has been driving the gold market thus far has been a lot of institutional buying, central banks picking up physical bullion, institutional buyers loading up on this stuff, countries who are trying to de-dollarize their asset portfolios and get into hard assets. Maybe they fear sanctions, they fear tariffs, they fear asset confiscation. There's a lot of things that have made these big institutions want to get into gold. But have they been buying silver? Not really. I mean, some industrial users perhaps have been loading up on this stuff, especially with the fear of tariffs ahead and thinking that imported silver, and the U.S. imports quite a bit, might get kind of expensive. But for the most part, institutions are not who drives the silver market, right? And that retail investors are not that interested in this stuff right now because premiums on retail products like little silver bars like this that are way too small for any kind of institutional or industrial buyer to bother with. But this is the sort of thing that, mom and pops and stackers like you and me are going to ultimately be focused on. The premiums on physical bullion remain very low, and that suggests that there's not a lot of interest in that right now. But the physical bullion market, it's a small market. And we got a hint of this back in March of 2023 when the banks started to fail and everybody wanted to get this stuff all at once. And immediately, pretty much overnight, what you saw with the failure of Silicon Valley Bank and the subsequent banking crisis was that premiums on physical bullion products, silver coins, silver bars, silver rounds, just exploded. And the shipping times were like weeks out. And it was revealed that there really just wasn't enough of this stuff to go around. And I think, we may not see, absent a crisis, that same kind of overnight move into physical bullion. But I do think with gold over $3,000, people are going to be paying attention to this. And again, we're just kind of nibbling at that $3,000 price level now. And that's kind of normal. That's one of the things that we've seen in the metals markets over the past years in this bull run is they'll kind of nibble at a price level that is resistance for a while. They'll try to take it out. They'll try to take it out. They'll try to take it out. And then boom, they shoot upward through it. And I think that is what is coming for gold. And when that day comes, then retail investors are really going to start paying attention, but they're going to some extent, be priced out of gold. And so silver, where institutional buyers don't affect the price of this stuff very much, retail investors really can. And silver is a small market. So when you get an influx of interest in this stuff, especially the physical kind, not the paper derivatives, but the real silver that you can see and hold in your hand, you're going to see this stuff move quickly. Now, luckily, there is still time to stack. I mean, that's what I'm doing. I'm still just kind of dollar cost averaging. I'm not going all in. I'm not panicking. I mean, who knows? Maybe we'll get a pullback here. We might get some opportunity to get into the silver market. But the moves that we saw this past week suggest that the bull market in gold and silver is alive and well, especially when you look at how well these things have held up in the face of a significant sell-off that we have witnessed in paper assets and stocks. I mean, gold and silver have not really participated in this pan sell-off type event. They're doing very well. Gold hitting record all-time highs. And silver, even though, it did pull back a little on Friday and it closed at 33.84, the 12-year high in silver is around 34.86. That's what we hit back in October of 2024. So we're just about $1 away from the 12-year high price in silver. So silver's holding up pretty well. Leave me a comment down below to let me know what you think is next and what is driving this interesting price action. And check out the video that's popping up on your screen right now. If you enjoyed this one, you probably like that one too. Don't forget to like, comment, and subscribe. Thanks for watching, everybody. Stay safe and happy stacking. Smart Silver Stacker out.